Certainly, the kinked demand curve is an economic concept that attempts to understand the demand for goods or services in the market. The principle of this curve illustrates a change in the estimated demand when there is a shift in the conditions of pricing and exchange among different producers. The behavior of the kinked demand curve depends on how producers are competing and determining their prices. This curve features a kink, from which it derives its name, indicating a sudden change in the direction of demand. One major reason behind this is that producers often do not reduce their prices when there is a decrease in their general costs, but they may quickly raise their prices when general costs increase. This results in a kink in the direction of demand. In this way, the kinked demand curve demonstrates a unique pattern that helps in understanding the relationship between price and demand in the market. The key features of the kinked demand curve are price stability. The kink in the demand curve implies that firms are hesitant to change their prices, leading to a range of stable prices. This stability arises because firms expect that a price decrease will not be matched by rivals, while a price increase might lead to a significant loss of market share. Rigidity in response. The kinked demand curve suggests that firms are more likely to match price cuts by competitors but are reluctant to raise prices in response to a rival's price increase. This behavior results in a gap or kink at the current market price. Non-collusive oligopoly. The kinked demand curve model assumes that firms in an oligopoly do not engage in explicit collusion, agreements to fix prices. Instead, they implicitly understand and respond to each other's pricing decisions without formal agreements. Uncertainty. The model relies on the assumption that firms believe their rivals will maintain prices in response to price cuts but match price increases. This mutual understanding contributes to a level of uncertainty, making firms hesitant to make significant changes to their pricing strategies. It's important to note that while the kinked demand curve is a useful theoretical tool for understanding certain behaviors in oligopolistic markets, it has its limitations and may not perfectly capture the complexities of real-world business interactions. Empirical evidence supporting the kinked demand curve hypothesis is limited, and alternative theories may also explain the observed behaviors in oligopolies.